In this video, I'll cover the key legislation to support business management and HR operations. The 7 acts shown in the boxes are listed from earliest to most recent. They'll be covered in summary format indicating who they apply to, the provisions, and compliance requirements. The websites where the full acts can be found is provided. The Revenue Act of 1978 contains several changes in federal tax laws that affect the business and individual taxpayers. Businesses were most pleased with the reduced corporate tax rates and the rate of taxation on realized capital gains. The Act added 2 important sections to the Internal Revenue Tax Code relevant to employee benefits. Section 125, Flexible Spending or Cafeteria Benefit Plans, to allow pre-tax money to pay for qualified medical expenses. Section 401k, Retirement Accounts, which was originally pre-tax savings programs for private sector employees known as Individual Retirement Accounts, IRAs. This later expanded to a second plan known as a Roth IRA that permitted funding with after-tax money. Individual taxpayers also benefited with new individual tax rates, the general tax credit, changes in itemized deductions, and the capital gains tax. The Tax Reform Act of 1986 made extensive changes to simplify the IRS code. Businesses received reduction in the corporate tax rate and suffered the loss of reduction in allowances for certain business expenses. The goal of the act was to increase fairness and to provide an incentive for growth in the economy by reducing the maximum rate on ordinary income and raising the tax rate on long-term capital gains. It eliminated many passive losses and tax shelters. This is the act which required all dependent children to have Social Security numbers, which reduced the number of fraudulent dependent children claimed on income tax returns by 7 million in the first year. Employee questions about numbers of exemptions to claim on their Form W-4 are influenced by this requirement for dependent Social Security numbers. Federal employees are protected by the Whistleblower Protection Act of 1989. If they disclose information that they reasonably believe is evidence of a violation of any law, rule, or regulation, or gross mismanagement, a gross waste of funds, an abuse of authority, or a substantial and specific danger to public health or safety. Whistleblower laws usually apply to public sector employees and employees of organizations contracting with the federal government or state government. Construction projects not being built to specifications can result in whistleblowing by government employees. The Act allows for federal employees who believe they have been subjected to reprisal because of their protected disclosures to seek protection and will be made whole by the remedies available under this law. While there's no specific act relating to whistleblowing for the private sector, it's important to highlight the issue of whistleblowing. Protections against retaliation are embedded in various laws we'll cover, which will include Civil Rights Act, OSHA, MSHA, SOX, ADA, and more. You'll soon become familiar with these acronyms. They're designed to protect individuals who publicly disclose information about corrupt practices or illegal activities within their employer's organizations. Often, such events occur when someone is mishandling money, contracts, or other assets. Employees of financial services companies, banks, credit unions, stock brokerage, and investment firms have been in the headlines during the recent years. They uncovered and disclosed misbehavior among other employees and were protected under whistleblower protections of various laws. OSHA's Whistleblower Protection Program enforces the whistleblower provisions of more than 20 whistleblower statutes protecting employees from retaliation for reporting. Whistleblowers are protected from disciplinary action, termination, or other penalties. The Department of Labor is ultimately responsible for its enforcement. The Small Business Job Protection Act of 1996 made it easier for small businesses to operate and create jobs. It increased the minimum wage requirements, simplified pension rules, and adjusted taxes for small businesses. The Act also made adjustments to S-corporation regulations, rules around safe harbor provisions, and rules governing worker employment status. It simplified the administration and maintenance of 401k defined contribution plans to encourage more employers to provide this type of retirement plan to its employees. Congress wanted to give taxpayers a couple of ways to lower their tax payments during retirement, so the Taxpayer Relief Act of 1997 was passed to create new savings programs called Roth IRAs and Education IRAs. Many individuals were to achieve a better tax position through these tools. Under this act, both small business and corporations benefit from increased exemptions and rule modifications to provide tax advantages. The failures of corporate executives at Enron, WorldCom, Tyco, and other public corporations to appropriately perform the fiduciary responsibilities led to the enactment of Sarbanes-Oxley Act of 2002. This act brought some strict oversight to corporate governance and financial reporting for publicly held companies. It holds corporate officers accountable for record-keeping and reporting financial information, including internal control systems to assure those systems are working properly. There are also requirements for reporting any unexpected changes in financial condition, including potentially new liabilities such as lawsuits. It requires the administrators of defined contribution plans to provide notice of covered blackout periods and provide whistleblower protection for its employees. The Act protects anyone who reports wrongdoing to a supervisor, appointed company officials who handle these matters, a federal regulatory or law enforcement agency, or a member or committee of Congress. It even extends to claims that prove to be false as long as the employee reasonably believes the conduct is a violation of the Securities Exchange Commission rules or federal law involving fraud against its shareholders. The Dodd-Frank Wall Street Reform and Consumer Protection Act, commonly referred to as Dodd-Frank, was a response to the 2008 global financial crisis and intended to prevent a similar instance. The act brought the most significant changes to financial regulation since the regulatory reform that came following the Great Recession. It made changes in the financial regulatory environment affecting all federal financial regulatory agencies and almost every part of the financial services industry. Since 1980s, the banks and other financial institutions have paid notoriously high salaries to their executives, sales individuals, and other high-level employees. Following the financial crisis, compensation arrangements in the financial sector have come under increased scrutiny. Dodd-Frank addressed these issues of pay and incentives most clearly in two distinct areas of the Act: the proposed rules governing bonuses and the pay ratio disclosures requirements. For global payroll stakeholders at financial institutions and publicly traded companies, these provisions are critical to understand. Studies have found that Dodd-Frank has improved the financial stability and consumer protection, although there have been many debates regarding its economic effects. The Act established the Consumer Financial Protection Bureau, which in its first 7 years has returned almost $12 billion to 29 million consumers and imposed about $600 million in civil penalties. The Act also amended the Fair Credit Reporting Act, which has an impact on HR.